Out of 100 people, 4 will get the message.
Welcome, gentlemen. I'm here at the Precious Metals Show in Munich with my 2 good friends, colleagues, and experts on the world political scene or economic scene, as well as, of course, on gold. In front of me here is the famous Ronnie Stoeffele. He's not just an advisor to our company, Matterhorn, but he's created a wonderful business called Incrementum, where they write the In Gold We Trust report, which is world famous and goes out in millions around the world. And Matt Piepenburg, he's a colleague of mine, ex-hedge fund, and also he's become an expert on gold in last 10 years at least, haven't you? And he works with Matterhorn. So we listened to your speech today, which was an excellent speech. Thank you very much. And we're interested in your, first of all, you spoke about Hopi Indians. And that rhymes with Matterhorn fantastically, because they were planning 7 generations ahead. And that's just wonderful, because that's the way we think about gold. We think about gold as something that, is generational wealth. And you have it for a long time, if you can afford it, of course. So, Matt, I'll ask you first, what do you think about this concept that Ronnie spoke so well about?
First of all, I think it was a brilliant contrast to, an Austrian economist speaking in German, quoting the Hopi American Indians and about thinking generations ahead. And I was thinking it's brilliant because metaphorically it really speaks to where we are today in the current current environment. Because I would say in the US and in Europe and elsewhere, it's the exact opposite policy. It's a very self-centered policy of thinking not even one generation ahead right now. In the central bank policy, this fantasy solution of printing money to pay for debt or monetize debt, to buy time, to buy market bubbles, to support bond markets, to keep interest rates under control, and to create a massive wealth transfer for this generation. What we've done, though, is mortgage the fund we're having now for our children's generation to pay. So I think Ronnie made a very good point with quoting the American Indians of how what a contrast that is to the current Western monetary policy, fiscal policy, political discourse, and everything from social unrest to monetary policy. It's really been thinking about now how we can buy time, buy votes, buy bubbles, and we'll worry about the consequences later, and maybe even blame those consequences on other things. I'm wondering if you think that's the shell game going on here.
Well, of course, we're kicking the can further down the road, but it seems we're running out of roads at the moment. And the leitmotif and the image that I wanted to present was from the movie. It's called Koyaanisqatsi. And Koyaanisqatsi in the Hopi language means life out of balance. And I saw this movie a while ago, and I thought, well, actually, there's so many parts of our life seem to be completely out of balance. It's not just financial markets, with extreme distortions in bond markets, in equity markets, in currency markets. It's also the political life being out of balance, our society being out of balance. So I thought, okay, well, it's probably a pretty good leitmotif for.
But Ronnie, I totally agree with you, and I often talk or write about that too. And as I see it, we are at the end of an era. We are at the end of a monetary era, which also means political and cultural era. And, we got the worst form of everything: politics, economics, false, fake money, adoring the golden calf, etc. So there's real decadence. So sadly, I think the world has to go through these massive downturns that I expect now in order actually to come back stronger. So we got to see all of these false values implode before we actually can grow again. But you talked about the Fed at the pivot point, and you actually think they will pivot early next year?
Well, the thing that I wanted to explain in my speech was that I just don't understand why the market really buys into this narrative that the new Paul Volcker is now sitting in the Federal Reserve, and that they're now really hawkish, and that they're restrictive, and that they're going to accept the recession. It's not going to work out like that. You know, the reason why so far the US economy is still pretty strong is, first of all, because there's huge time lags involved. We financial guys, we always think that everything is discounted right away. But if you talk to private people, if you talk to business people, I think they now slowly start realizing what's actually happening on the rate side. Just
when you say that, one thing I've learned is patience.
Yes.
Things don't happen just because you think they're going to happen now. It takes a lot longer.
Exactly.
So,
Exactly. And I mean, we've got, at the beginning of this year, rates were still at 0.
Yeah.
Now, in the first quarter of next year, they're supposed to be at 5%. Now, 5%, such a quick move in the most interest rate sensitive environment ever, because we've got by far the highest debt levels ever. That just tells me, well, actually, perhaps I'm just a poor economist, a market observer, or I just don't see why the market really thinks that they're gonna orchestrate a soft landing in the United States. Although I have to say, I was in the States for 2 weeks, and I would say on a relative basis, the US is still doing much, much better. I think we expect falling inflation over the next couple of months in the US due to the base effect, due to the some statistical things, and also markets are now slowly seeing, well, actually we have probably seen from this inflation wave, we expect 1 or 2 more inflation waves following. But I think if inflation is going down now, this will give central bankers much more leeway and say, well, we did it, we broke inflation, and then they can start the pivot.
Yes, but in my view, yes, nothing goes straight, and therefore inflation might very well come back a bit. But I believe that inflation is now on a rising trend long term, and this whatever short-term pivot is only going to be temporary. What's your view on inflation?
I think there's so many themes that overlap. Again, it goes back to the original leitmotif of this imbalance, this disconnect between reality and words, or math and words, or history and words. And this notion, as you indicated, of Powell being the next Volcker, or Volcker reborn, is really nonsense in so many ways. And sometimes it's just as simple as comparing 2 simple numbers. The debt levels in 1980, when we were at less than $1 trillion or 800 billion, to 30 trillion, 31 trillion today. I mean, Powell literally mathematically cannot afford to be Volcker reborn. It's simply...
And that's just on a government level.
That's just a government debt.
Yeah.
So you're not even talking about household debt and corporate debt, which is over 90 trillion combined. So that is something that I think isn't being honestly discussed, because we're lacking a lot of honesty and openness. So there's a headline commentary, there's a political commentary, and then there's basic math. And the ganze Menge, the people, the public is not really naturally understanding that. They're not getting that honestly. And this lack of transparency, this lack of just accountability from central bankers and politicians, maybe is one of the reasons you were in Colorado and thought Americans were a little more optimistic. I hate to say it, but they're getting less direct, transparent information, I think, that we see sometimes here in Europe, because the news is so politicized. And I think that's sad that we don't have that clear kind of honesty. But no, I don't think inflation is going to be solved by higher rates. When we know that the official rate and the actual rate are very different, but even if you try to get to a neutral rate, you have to raise rates so high that our corporate debt, our public debt, can't afford that kind of rate hike. So the way I think they're going to fight inflation, or try and take credit for, is by engineering a recession, which has a tremendous effect on supply and demand forces, and that's how they're going to take credit for it.
The one danger in this scenario is that we have a lot of debt which might not be repaid at all, and that we will see failures in the bond market. And I expect that in the next year or so that's going to happen. And therefore, the bond market will be continuing to sell off, although there might be a temporary correction. But therefore, I see that the long-term rates are going to push the short-term rates down by this, long-term rates are going to pull the short-term rates up, because we will see liquidation in bond markets. People will start worrying about solvency, and there isn't any solvency in the world today. We've seen that already with the Bank of England supporting the British pension fund market, which is ridiculous because they speculate in derivatives. And we've seen the Swiss National Bank having to inject money into the Swiss banking system. So we are looking at real pressures in this market and therefore the danger of insolvencies. And that in itself means that the bond market, especially starting with the long end, will sell off and long-term rates will go up and then they will pull up the short-term rates. I think there's a great risk of that in coming years at least, or in the, even if not short-term. So, but go ahead, Ronnie.
I mean, I think what's really important, and as you said, actually the strategy has been, and William Dudley was quite vocal about it already in spring, saying, okay, with this reverse wealth effect, basically destroying capital markets, we can orchestrate a recession, just a mild one, and get inflation numbers down. Now, actually, this inverse wealth effect, that's 60 trillion in global bond and equity markets. 60 trillion, that's 65% of global GDP. So that's a pretty big number. And I just don't see how, especially US consumers that are probably more dependent on capital markets and that follow equity and especially real estate markets probably more closely than Europeans, that they don't adjust their spending behavior. I talked to a very, very rich man recently. He doesn't
Typical
have to,
for normal people, obviously.
he doesn't have to work, and I think the next 2 or 3 generations, if they don't screw it up, they will probably screw it up anyways. But he said, well, I did cancel my membership in a tennis club.
Yeah.
I said, well, actually that doesn't make a big difference, in relative to your overall wealth. But he says, I'm feeling poor now, And I just to explain how this reverse wealth effect works, and the reason why the US economy is still holding up well is because most of them are completely maxed out. There was a very good interview with the CEO of Walmart where he said the spending behavior completely changed. People don't pay cash anymore with the debit card, but rather with the credit cards. So this is kind of still holding up the US economy. But as I've said, a recession is totally our base case. And I do not see the Federal Reserve in a brutal recession not making a big pivot. I just don't see it. The pressure from Wall Street will be way too high, way too high.
I agree with you, but the risk is very high that times will be so bad that no debt will be repaid. And this is when you get pressure on the credit markets, and therefore you could get defaults. And then rates will go up whether they want it or not. They can't control. They've never been able in long term to understand anyway. The federal central banks never understood interest markers or they've always been wrong on any forecast on inflation going up or going down. So why would they be right now? But we're here at the gold conference, of course. And we haven't even mentioned gold yet. So we have to have final word about gold, and actually we on a day-to-day gold is up because we are here. Right. Market is listening. It's up $40-50, something like that, and silver is up even more, 5% almost.
I'll certainly give some thoughts on gold, but this is the author of the In Gold We Trust report, so I think he should have the final word. But I think all of these things are connected that we've been talking about. I think this notion this arrogant notion from the central bank in the U.S. that they can kind of control a recession, contain a recession. Even Powell's talking about maybe he can do a soft-ish landing. I think that's incredibly naive and incredibly arrogant. And I think to your point about the bond market, where the interest rates go, I know in my hedge fund days, we always looked at the bond market to really give us our signals. And what you're saying about is these bonds go under stress and there's less and less demand, natural demand, then the yields get too high. And if the yields get too high, the interest rates go too high. And in a world surrounded by debt, rising rates are like shark fins. And so I think to your point, the Fed will have to pivot. They can't support, there's no natural demand for the great deal of the sovereign bonds out there. So they're going to have no choice but to pivot. When they do that, you're going to see another, I think, temporary melt up in the risk asset markets. But we all know that monetary support is also inflationary. It's debasing money. And as it debases money, I think that's going to be an interesting time for cryptos, a very interesting time for gold. So of course, longer term, there is no natural demand for our IOUs around the world, our bonds. The only way to really solve that is not going to come from growth or GDP or income tax receipts, so we're going to go to the money printers globally. That's going to be debased money, which is going to be the ultimate tailwind, I think, for gold. So right now, being patient, listening to gold bugs, it's really not about gold bugs, it's about interest rates, currency debasement, and basic math and debt. So I think gold is definitely and you made a great point today, Ronnie. We're also looking at the strong US dollar. Gold and other currencies like the yen or the British pound sterling is a different chart. The dollar is unusually unnaturally strong right now, but I think that too is temporary. So I'll close with those thoughts and let you kind of finish your thoughts.
Final word on gold.
Yeah.
From our expert here.
Gold is just fine. I mean, the last time I looked at my gold in the vault, it still was there, yeah.
Yeah, and you were thinking 7 generations ahead anyway.
Exactly, and I've got a couple of daughters, so I have to think ahead.
Yeah.
No, but I think, as I've said, we're seeing this brutal market forces due to this. We've never seen a more aggressive rate hike campaign, yeah. And actually, it's not even equity markets being down big time. The bond market has the weakest year since 1865. 1865. Now, actually, in 2008, when equities were down big time, bonds basically kind of compensated your losses. Now, the typical balanced portfolio is totally screwed. And then, I would have to say, in this brutal market environment, with this big tornado going on, I think gold is, as a little shelter, I think it's doing just fine. In euro terms, it's up 4% year to date. In dollar terms, obviously, it's down 9%. In many currencies, in Japanese yen, for example, it has made so many new all-time highs this year. So actually, the world gold price that we calculate is very, very close to all-time highs. Just in spring, gold almost made new all-time highs in dollar terms. So I think once we see this pivot, I think we can make new all-time highs also in dollar terms pretty quickly. However, I think what's really more important is, first of all, what's going on in emerging markets. We're seeing the BRICS, but also the SCO making many deals recently. We see many countries want to join the BRICS, for example. And actually, if you have a look at the World Gold Council report recently, we're seeing record amounts of gold demand from central banks from emerging markets.
Only from, not from Western countries at all.
Exactly. So I think this is like the bigger picture that is going on. Countries that are basically a little bit critical of the US and our current setup, trying to diversify out of the US dollar, diversify out of US Treasury. And actually gold, I think, is a pretty good choice. It's super liquid. It's got a very low bid-ask spread. It's traded all over the globe. It's accepted all over the globe, and it doesn't have any counterparty risk. Yeah. So I think in the grand scheme of things, this is really more important than trying to forecast if gold is going to 1800 or 1900 in the next couple of months. I think with the current setup that we are in, I'm super relaxed regarding gold.
But what is interesting is, and of course investors sadly focus on the very short term, and many people buy gold for the wrong reason. I mean, for speculative reasons. They hope will look up the day after they buy it. But it is doesn't need to be 7th-generation investment, but it certainly is. It is a longer term investment, and longer term we know that governments and central banks are totally behind the gold investor and guarantees over time that gold will always go up like it has for 5,000 years, since all currencies go to zero, as we know. And therefore, it's so easy. Gold will go up, will continue up. And we're looking at these short-term swings. Dollar is a little bit stronger. I mean, the dollar over the last 50 years has collapsed by 80-90%, depending on how you measure it in gold or in Swiss francs or whatever. So, we know that gold will always be the winner. It's just that we have to think a little bit further ahead, and that's why we really enjoyed your presentation on the 7th generation. So I think we'll finish there. It's really great to meet here, and we have a fantastic gold crowd here, all interested in talking to us. So thanks very much, both of you.
Great.
Matt, Ronnie,
Thanks,
thank you.
Thanks.